When the crash finally arrives in 2026, it won't announce itself with a single moment. It will seep in, quietly at first, like a glitch. A payment delay here, a missing paycheck there, a bank app that refuses to load. People will call it a technical issue, they always do. But beneath the surface, the system will already be drowning. In the opening hours, markets will still pretend to function. Screens will turn red, but analysts will cling to the same script they've repeated for decades: temporary volatility. They said it in 2000, in 2008, in 2020. They will say it again, because admitting the truth would mean admitting that the foundations of modern finance have been rotten for years. But the cracks will spread too fast this time. Liquidity will evaporate, credit spreads will explode, and the algorithms that were supposed to stabilize the system will begin feeding on the panic they detect. By noon, the first emergency press conference will appear. It will be filled with the same rehearsed reassurances. We have the tools, markets remain resilient, our banking system is strong. But the cameras won't catch the real story. Central banks across continents quietly activating swap lines, commanding overnight meetings, and begging their counterparts to supply whatever is necessary. Those who lived through 2008 will feel that familiar tightening in their chest, the dread of déjà vu, the sickening realization that the story is repeating, but this time there is no space left to maneuver. Around the world, ATMs will begin limiting withdrawals, not because the money is gone, but because trust is. And once trust evaporates, every dollar becomes a prisoner of fear. People will line up, not yet panicking, but with that anxious silence that precedes it, the kind that spreads faster than any contagion. A mother trying to pull out rent money will be told her daily limit is for stability. A shop owner will discover his business account is temporarily frozen. Banks won't call it a bank run. They will rename it Liquidity Protection Protocols. Language is the first casualty of a failing system. As the sun sets, global markets will close, some violently, some suspiciously early. Headlines will scramble for metaphors. Black Monday 2.0, the Great Freeze, the Liquidity Winter. But none of them will capture the deeper truth. This isn't a sudden heart attack. It's the culmination of years of policy decisions that traded tomorrow for today. A slow-motion failure, decades in the making. Because the collapse of 2026 didn't begin in 2026. It began when central banks pushed interest rates to zero and refused to let markets breathe. It began when governments borrowed without restraint, convinced that debt no longer had consequences. It began when corporations discovered they could issue endless bonds to buy back their own shares, inflating valuations far beyond anything tied to real productivity. And it began when society embraced the illusion that crises could be printed away, that every downturn could be soothed with one more stimulus, one more bailout, one more intervention. For 18 years, the world treated the 2008 crash like a virus that had been cured. In reality, the system never recovered. It was kept alive through life support, quantitative easing, suppressed yields, artificial liquidity, and the quiet acceptance that future generations would pay the bill. The banks were not reformed, they were simply shielded. The risks were not eliminated, they were redistributed into pensions, into housing markets, into the balance sheets of nations. The irony is cruel. The tools used to save the world in 2008 are the same tools that made 2026 inevitable. Zero interest rates created bubbles in everything from tech stocks to farmland. Cheap credit produced a generation of zombie companies, firms that can only survive as long as money remains nearly free. And when inflation finally returned, the central banks found themselves trapped. Raise rates and trigger collapse, or keep rates low and let inflation devour savings. They chose delay. Delay always has a cost. By the time the world realizes what's happening, it will already be too late to stop. The crash will not be a single moment of destruction, but a cascading breakdown. Margin calls triggering forced liquidations. Governments scrambling to fund deficits as bond markets revolt. Savers discovering their banks don't actually hold their deposits. Supply chains seizing as credit dries up. A multi-organ failure of a global financial system that spent nearly 2 decades pretending it could outrun gravity. And in those early chaotic hours, as news anchors recycle phrases from 2008, people will finally ask the question they should have asked long ago. If the last crisis was the warning shot, what exactly have we been living inside all this time? What did we build our recovery on? And why did we believe that debt, leverage, and artificial liquidity could support an entire world? The truth is simple and brutal. 2008 was not the collapse. It was merely the tremor, a prologue, a signal of a system that was beginning to fracture. The crash of 2026 is the breaking point, the moment when all the debts, all the distortions, all the hidden vulnerabilities converge into a single, uncontainable event. And when it hits, it won't feel like a crisis. It will feel like the end of an era. The story of financial collapse is never new. It only feels new to the people living through it. Every generation believes its crisis is unprecedented, a one-in-a-lifetime anomaly caused by unforeseeable forces. But history has a way of stripping away illusions. When you look closely, every major financial breakdown follows the same architecture, an invisible blueprint etched across a century of booms and busts. The pattern begins with euphoria. It always does. Cheap money pours into the economy. Credit becomes effortless, and the future looks too bright to question. In the 1920s, it was the explosion of margin trading. In the 1970s, it was the illusion that inflation could be controlled without consequence. In the late 1990s, it was the intoxicating promise of the internet age. In the early 2000s, housing became the safe bet that could never fall. Each era had a different story, a different protagonist, a different excuse, but the underlying script was eerily identical. Money gets cheap, leverage grows, and risk becomes invisible. Then comes the expansion, the phase where people begin to trust the system too much. The graphs move up and to the right. Politicians declare victory. Banks congratulate themselves. Economists convince the world that this time is different. They invent new models, new narratives, new myths to justify the unnatural stability. Soft landings, efficient markets, permanent prosperity, phrases polished and repeated until they sound like truth. But beneath the surface, debt accumulates like pressure under a fault line. Once leverage becomes the engine of growth, the next stage is inevitable: fragility. Fragility hides behind the illusion of strength. In 1929, investors believed the market had reached a permanently high plateau. In the 1990s, analysts insisted profits didn't matter because the internet had changed the rules. In 2007, bankers swore that mortgage bonds were safer than government debt because computers had sliced them into risk-free pieces. Fragility is always dressed as innovation. And then, without warning, the smallest spark ignites the collapse. A fund blows up. A currency peg breaks. A bank quietly fails over a weekend. The trigger doesn't matter. What matters is the accumulated leverage behind it. The tower of debt built during the good years. Once the first brick falls, the rest follow with perfect, horrifying predictability. The crash phase is never just an economic event. It's a psychological one. In every crisis, 1929, the 1973 oil shock, the 1997 Asian contagion, the 2000 dot-com burst, the 2008 global financial meltdown, confidence evaporates faster than capital. People stop trusting banks, markets, governments, and sometimes each other. Money tightens. Liquidity dries up. The same leverage that amplified the boom now accelerates the fall. And as always, the ones who never benefited from the bubble end up paying the price. But here's the part of the pattern most people refuse to acknowledge: the bailout phase. After every collapse, the same institutions that inflated the bubble reappear as saviors. They promise stability. They promise reform. They promise to Never let this happen again. And then they begin the most destructive part of the cycle, intervention. In 1929, intervention was limited, and the crash spiraled into the Great Depression. So by the 1970s, governments had learned to stimulate aggressively. By 1997, the IMF stepped in with international rescue packages. By 2008, central banks became superheroes, slashing interest rates to near zero and printing money on a scale the world had never imagined. The message was clear: the system would always be rescued, no matter the cost. The result was predictable. With every rescue, markets took greater risks. With every bailout, debt grew larger. With every intervention, the next bubble inflated faster. A century-long supercycle of credit expansion began, each crisis requiring more extreme measures to contain. The boom-bust rhythm became a kind of financial heartbeat, steady, repetitive, impossible to escape. And yet, each time, the public believed the narrative. This was the last one. The system is fixed. The rules are stronger now. But the rules were never stronger. They were simply postponed, delayed, deferred into a future that is now rapidly becoming the present. When you map the past crises, 1929, 1970s, 1997, 2000, 2008, one truth becomes impossible to ignore. Each collapse was larger, more global, and more complex than the last. Each bailout created the conditions for an even bigger shock down the line. Each fix was less effective, more desperate, more dependent on the illusion that central banks could control forces far larger than themselves. This is the pattern, a loop, a machine, a cycle that no one in power truly wants to break, because breaking it would mean confronting the real cost of decades of borrowed prosperity. And that is why the crisis approaching in 2026 is not random. It is not accidental. It is the logical endpoint of a system that has been running the same algorithm for more than 100 years. The boom, the leverage, the fragility, the spark, the collapse, the bailout. A perfect loop, repeating until the system itself can no longer bear the weight of its own design. And for the first time in modern history, we are approaching a point where the usual rescue mechanisms no longer work, where the next downturn threatens not just markets, but the cycle itself. The past is not warning us, it is showing us the script, and the next act has already begun. The most unsettling truth about the present moment is how familiar it feels, like standing in the echo of a disaster we once survived, but never truly learned from. When you place the world of 2006 next to the world of today, the resemblance is not just symbolic. It is structural. It is mathematical. It is the kind of parallel that makes history feel less like a lesson and more like a warning siren. In 2006, the global economy hinged on a single fragile pillar: housing. Subprime mortgages, teaser rates, adjustable loans. Millions of households leveraged their futures on the belief that home prices could only rise. Banks multiplied that risk through complex derivatives like CDOs, creating a labyrinth no one, not even the architects, could map. But back then, at least the madness was contained. The bubble was huge, infectious, and corrupt, but it lived mostly inside one sector. Today, the bubble is everywhere. Where 2006 had a housing bubble, 2024 to 2026 has an everything bubble. Stocks priced for perfection, real estate inflated across continents, private equity drowning in leverage, venture capital throwing billions at companies with no profits and no path to get there. Even government bonds, once the bedrock of safety, are flashing signals of instability. The fragility that once lived in a single corner of the economic system now sits at the center of everything. And just like in 2006, the danger hides behind a mask of optimism. Back then, they told us housing was safe because real estate never goes down nationally. Today, they tell us AI will grow infinitely, that tech valuations don't need to make sense, that interest rates will fall soon, and that governments can borrow forever because debt is just an accounting tool. The script hasn't changed, only the actors have. There's another parallel, one far more dangerous. In 2006, people didn't realize how interconnected the system had become. Mortgage defaults in one state triggered chain reactions across global banks. Leverage turned local failures into planetary shocks. But even then, the network was primitive compared to today. Now the financial system is woven together in ways that make 2008 look almost quaint. Shadow banking, private credit markets, derivative exposure tied to ETFs, algorithmic trading, and high-frequency strategies create a hyperlinked web where risk no longer moves, it teleports. A crisis in a mid-sized bank in Europe can ripple into US equities, Chinese real estate, and emerging market currencies in hours. The global economy is not just connected, it's wired like a nervous system waiting for a seizure. Yield curves today echo the same pre-crisis shape as 2006, deeply inverted, screaming that recession is coming. Corporate debt sits at record highs, fueled by years of near-zero interest rates that allowed zombie companies to survive far longer than capitalism intended. Governments are running deficits that would have been unthinkable 2 decades ago. And inflation, once thought conquered, has returned like an old enemy with a sharper blade. In 2006, the story was that homeowners could always refinance. In 2024 to 2026, the story is that governments can always print. Both beliefs are delusions built to delay the reckoning. But the most chilling parallel of all is psychological. In the years before 2008, the public sensed something was wrong, but the fear was muted by record asset prices. People told themselves to ignore the unease because everyone else was getting richer. The same mood hangs over today. People know something feels off. The volatility, the layoffs, the inflation, the political instability. But because the markets still stand, because the bubbles haven't burst yet, they convince themselves that stability is returning. It isn't. The pre-crisis calm of 2006 was not a sign of health. It was the silence before a fault line snaps. And the calm of today carries the same cold weight, the same false comfort, the same eerie stillness. Nothing about this moment is normal. The warnings are louder, the stakes are higher, the imbalances are greater. And unlike 2008, the world has no clean escape route left. Back then, central banks slashed rates to zero. They printed trillions. They bailed out the system. But those tools have already been used. Rates are already near their limit. Debt is already stretched. The system is already swollen with artificial liquidity. And inflation now prevents the same kind of unlimited rescue. In 2008, policymakers had ammunition. In 2026, they have only consequences. The parallels are not coincidences. They are proof. Proof that the world has been circling the same vortex again and again, each time descending deeper. Proof that the past was prologue, not resolution. Proof that the crisis forming today is not a repetition, but an escalation. If 2008 was the warm-up, this is the main event, and the similarities between then and now are not warnings, they are countdowns. For years, the world was told that the financial system was repaired after 2008. Regulations strengthened, banks fortified, central banks vigilant. That was the narrative, clean, reassuring, and carefully crafted. But the closer you look, the more that narrative dissolves. Because beneath every crisis, beneath every bailout, beneath every miracle rescue, there is a truth most people were never meant to see. The system isn't broken. It's designed this way. The real revelation isn't that a crash is coming, it's that the people in charge of preventing it built the conditions that guarantee it. Start with the central banks, the guardians of stability. Their mandates sound noble: maintain price stability, support employment, safeguard the financial system. But their incentives reveal something darker. Central banks fear deflation more than bubbles. They fear market panic more than moral hazard. So every time the system trembles, they flood it with cheap money. Every time leverage threatens to collapse, they rescue it with lower rates. Every time markets ask for discipline, they override it with liquidity. And in doing so, they quietly became the sponsors of risk. After 2008, they pushed interest rates to zero and printed trillions. Not for ordinary people, not for workers who lost jobs or families who lost homes. The rescue was engineered for the top of the pyramid, the banks, the hedge funds, the corporations. They were the first recipients of new money, the first beneficiaries of liquidity injections, the first to profit from asset inflation. Ordinary people only received the aftershocks: higher asset prices, more expensive housing, wages that never caught up. Then came the banks themselves, institutions that privatize profits and socialize losses with methodical precision. The public was told banks became safer after the crisis. But what really happened? Their risks were shifted into the shadows, into the exploding world of private credit, into off-balance sheet vehicles, into derivatives hidden behind regulatory loopholes. Many banks grew larger, more complex, more intertwined than they were before 2008. They were not disciplined. They were emboldened, because they learned the lesson the system truly taught. If you are big enough, interconnected enough, or politically important enough, you will be saved, no matter the cost. And they acted accordingly. Corporations joined the game next. They borrowed money at near zero rates, not to innovate or build, but to buy back their own shares, inflating valuations and executive bonuses. Entire sectors became dependent on debt for survival. Zombie companies, firms that can't even cover interest payments, were kept alive by the artificial generosity of monetary policy. In a real capitalist system, they would have failed. In this system, they became permanent residents. But the most revealing part of the design is how government stepped into the loop. Rather than confront the underlying fragilities, exploding debt, global imbalances, demographic decline, they leaned on stimulus, deficits, and manufactured optimism. They reassured voters that debt didn't matter, that central banks could always print more, that the safety net was infinite. But every dollar borrowed was a silent transfer from the future to the present, from the many to the few. Because the truth is this: every bailout, every rescue, every emergency measure concentrated more power upward. It wasn't an accident, it was the trade-off. The elites weren't saving the system, they were absorbing it. Consider who benefited from the last 15 years of monetary distortion. Billionaires multiplied. Megacorporations consolidated. Asset owners saw explosive gains. Meanwhile, the middle class hollowed out. Savings lost value. Home ownership drifted out of reach. Inflation quietly eroded purchasing power. Inequality didn't just grow, it became structural. And with every crisis response, the structure tightened. This is the revelation the public was never meant to see. The cycle of boom, bust, and bailout is not a flaw in the system. It is the operating model of the system. A model where risk is pushed downward, where profits rise upward, where failure is forgiven at the top but punished at the bottom, where each crisis creates the justification for more control, more surveillance, more intervention, more dependence. The crash of 2026 is not just a financial event. It is the bill for decades of engineered imbalances. It is the moment when the system's internal contradictions finally collide. And when the collapse comes, the same architects who inflated the bubble will return to the stage, not as culprits, but as saviors. They will offer solutions that consolidate even more authority. Digital currencies, capital controls, tightened regulations that crush small competitors but spare the giants. The public will be told these measures are necessary. They will be told the crisis was unexpected. They will be told this time the rescue is for everyone. But the truth will be the same as it's been for a century. They knew the price. We pay the cost. The crash is not the revelation. The revelation is that they engineered the conditions for it. and position themselves to thrive when it hits. The most painful part of understanding a crisis is realizing that some events don't happen to us. They happen because of us, because of the choices society made, because of the illusions we accepted, because of the comforts we refused to let go. The crash approaching in 2026 is not a twist in the story. It is the ending that was written long ago, the final chapter of a system that has stretched itself beyond its natural limits. But inevitability is never the same as helplessness. The world has spent nearly 2 decades living inside a paradox: growth built on debt, stability built on manipulation, prosperity built on borrowed time. Every fix for the last crisis created the fuel for the next one. Every bailout prevented collapse by making the foundations weaker. Every intervention bought time at the cost of the future. The reckoning was postponed, not prevented, and now the bill is due. The mechanisms that once saved the system no longer function. Rate cuts can't solve inflation. Money printing can't restore trust. Bailouts can't revive productivity. The tools that defined the post-2008 world, QE, zero interest rates, liquidity injections, are now relics of an era that can't be resurrected. Policymakers know this. They won't say it out loud, but their actions reveal the truth. The system is cornered. And when systems are cornered, they don't become careful, they become controlling. That is the part few people are prepared for. When the crash comes, the story won't end at falling markets or frozen banks. The deeper danger lies in what comes afterward, the tightening of hands around the levers of money and power, the shift from persuasion to enforcement, from recommendation to mandate, from choice to necessity. Capital controls framed as temporary stability measures, digital currencies framed as modernization, restrictions framed as consumer protection, surveillance framed as security. The public will not see these changes as threats, not at first. They will appear in the fog of crisis, presented as solutions to chaos, as tools to restore order. But their true purpose will become clear only later: to consolidate authority in a world where traditional tools no longer work. Because once trust collapses, control becomes the replacement. Yet even in a system designed to absorb power upward, individuals are not without agency. The inevitability of a crash does not mean the inevitability of personal ruin. For those who understand the cycle, who see through the narratives, who refuse the sedative of false stability, there are choices, quiet, unglamorous, but powerful. Reducing personal leverage, holding assets that don't evaporate with liquidity, keeping buffers of cash, of essentials, of independence, learning to live with less illusion and more clarity, recognizing that resilience is built long before it's needed. Not everyone will choose this path, most won't. Most will cling to hope that the system will return to normal, unaware that the normal they remember was already an illusion, propped up by debt, distortion, and denial. They will wait for the rescue. They will trust the reassurances. They will hope the storm passes. But storms don't pass when the ocean itself is rising, and that is the final truth of this era. The crash is inevitable because the cycle demanded it, because the system required it, because the years of excess left no other ending. Yet within that inevitability lies a smaller, sharper freedom, the ability to prepare, to anticipate, to refuse to be the last one holding the bag. The world built the trap. They tightened the walls. They lit the fuse. But the choice of whether you stand inside when it detonates, that choice is still yours. And when the dust settles, when the old system collapses under the weight of its own contradictions, the future will belong not to the ones who trusted the illusion, but to the ones who recognized the sound of an ending long before it arrived.